So, ladies and gentlemen, welcome to today's call organized by PMSCIF World and Ambit. We at PMSCIF World, I am Sankalp and I represent PMSCIF World. We are one of India's leading, PMS and EIF platform. So I'm getting some comments on the chat box saying no audio. Manisha, am I audible to you? Aishwarya, am I audible to you?
Perfectly fine.
Uh, I don't know. I've gotten a lot of comments saying no audio. Yeah, so audio is fine now. So fine. So we'll start. Like I was saying, I'm Sankalp. I represent PMSCIF World, and we of India's leading platform for portfolio management services and alternate investment funds. We've done a lot of good work, and all of it is available to the public at large. And they can go to our YouTube channel or our website, and they can also book a call with us to know more about portfolio management services in India. But enough of that. Today, we have scheduled this call, and the topic is very intuitive. We call it the Ambit approach to building a portfolio, a pandemic-proof portfolio, and we have gotten the fund managers from Ambit, Manish Jain and Aishwarya Dadich, with us. This is going to be, as the title suggests, a very interesting session. And what once I realized is that a session is as good as what we learn from it. So someone told me at the end of the session, I as a moderator should feel that I have taken back something good. So, and I'm hoping this is going to be one such session. Okay, and my guests Manish and Aishwarya will ensure that. So a little bit about Manish. So Manish has been in this business for 16 years and around 2.5 years at Ambit. He is CFA level 2 certified candidate. CFA level 2 certified analyst. He's done his MBA from Symbiosis Pune. He has worked with marquee names like Nomura India, Enam Securities, ICICI Securities, and Motilal Oswal. He is the thought leader behind a lot of Ambit's leading publications like from the Fund Managers Desk, the Disruption Desk, the Disruption series, and others. He has also been consistently one of the top analysts across different sectors. Second guests, Manish, if you can just, because we have two faces on the screen, can you just wave to the, so that's Manish for you guys.
Hi guys.
So sitting calmly on the other side is Aishwarya. Aishwarya is equally, experienced, and he's been there managing, donning different hats, and he has been with Ambit for 4 years and an overall experience of 15 years. He too is a CFA charter holder, a CA, an MBA Finance, and BCom from St. Xavier's College, Calcutta. So he started his career at CRISIL and as an equity research analyst, and moved to Nippon, where he managed, amongst other things, one of their small cap, one of their equity funds, which began at a small AUM of 160 crore and grew tremendously over the next few years. Okay, so at Ambit, he has been managing two strategies, both mid and small cap strategies, so that I am sure you will have a lot to share with us today. So, before I hand it over to you, let me set the context. Okay, so this is a series where essentially we will talk more practical. We will, with the disclaimer of this being more educative than advisory, we will talk about stocks. We will talk about how the pandemic has impacted portfolios, and how the pandemic will impact investment decisions. Okay, so these will be the objectives. So over to you, and Manish and Aishwarya, who wants to begin, over to you, and let me know when I can run the slides.
Yeah. So let's start. Sankalp, share the slides. Yeah. In the meantime, it's been a very interesting last 1.5 year, right? We've gone through a proverbial, roller coaster ride, if I may, say so. Essentially, the fact being that we've gone from, the expectations of economy stabilizing, which was around the beginning of last calendar year, to suddenly this whole pandemic crisis, emerging out like a giant tsunami, engulfing the whole global population and the economy, and essentially resulting in what was a massive tumble off the cliff, right? We fell, and resulted in almost a 24-25% decline in the GDP growth rate in the first quarter last year. And as soon as we were recovering out of it, and we were pretty overconfident, if I may use that word, we were right in the front of the queue. Most of the countries in the world, including some of the developed ones like UK and US, were going through multiple waves, second wave, third wave, right? As early as November, December, we were celebrating the fact that we've defeated Corona and that it was going to be history. Most of us had started venturing out of our houses. We were holidaying, right, visiting restaurants, eating out, etc., and all life was normal. When suddenly in April, the second wave came, and it was again this time not a wave, but it was a tsunami, and the magnitude of it has hit us so hard from a human life perspective that some of us, or in fact most of us, have lost somebody who's near to us and has suffered some kind of a loss. Now, the fact of the matter is there are two questions that you need to ask yourself here first. Now, because we are living in these tough times, we believe that nothing of this sort has ever happened before. First, it's wrong, right? Instances like these, which can be termed as global human crisis, right, have actually happened with amazing regularity. If you look at the last 100 years, this is probably the sixth or the seventh such crisis which has happened, which has taken a toll, of this magnitude globally, right? And the second thing is that every time something like this has happened, we've always felt that the world is ending. We've always asked ourselves this question, that where do we go from here, right? Where we are today here, most people will be asking this question, that the markets have not corrected, right? The Nifty is still at 15,000 plus, and what do we do in times like these? Because obviously the economic impact is going to be great, and the GDP is going to come down from what we were expecting it to be earlier. So what do we do now, given that markets suddenly start looking expensive again, right? Which were looking cheap in March, are now suddenly early April, are now suddenly looking expensive again. What do we do from here? Now, first of all, this is not the biggest crisis that the world has ever seen. If you look at the context over here, Spanish flu was much bigger in terms of magnitude. We lost 40 million people worldwide. We have lost just 1/10 of that number. In fact, we lost a similar number when the Asian flu had hit the world in 57, 58. Right. So that's essentially something that you need to take into account. And even from a GDP growth impact, the world has lost about 4.5% of GDP. And again, we've seen worst, right, in the past. We've seen 6% negative impact as far as the Spanish flu was concerned. We've seen 2% negative impact in today's term in Asian flu, 1% when swine flu hit us, when the World War II happened. Germany, inarguably the hardest hit country, and at that point of time, the industrial output was down about 20%. So the economies were hit really, really hard. So to say that at that point of time, people were in a very similar situation, asking the same question, right, as to where do we go from here and what do we do, what is a path forward. Now, if you look at it, what is interesting is the way the economy rebounded and recovered from that, right? Spanish flu ended in around 1920, 1921, 1922, 23, 24. Look at US GDP growth rate numbers, 6%, 13%, 4%, right? When you look at Asian flu, right, again, you look at the recovery, 7%, 2.5%, and 2.5%, right? And then if you look at the swine flu, 2.5%, 1.5%, and 2.2%. And when you look at COVID now, again, CY21, we are looking at 6.5% kind of a GDP growth rate coming from US. So the fact of the matter is that the economy rebounds, and it just doesn't rebound in a W formation or in a U formation, but it's a very sharp V-shaped recovery which happens, right? And so do the markets. When you look at the Dow Jones industrial index, and you look at both the charts over here, you'll see the way it has rebounded, right? 100 years back, which is a chart on your left side, and today on the right hand side. The thing to keep in mind is markets are always going to be forward looking. Markets are always going to start factoring in as the wave is coming to an end, as it is coming nearer to a closure, and the markets are going to start reacting much before you do, which is pretty much what I suspect is happening in India now. You look at the way COVID cases pan India has started coming down. For the first time, we've had less than 2 lakh numbers. States like Maharashtra and Delhi are now starting to talk about open up. Hopefully, we'll get some good news next week. And Aishwarya is going to touch upon this later on in greater detail, but our assessment is that there is going to be not much of an economic impact as far as the GDP growth rate is concerned. This year, you'll still see a low double-digit kind of a GDP growth rate very confidently, anywhere between 11 to 12% range is what our ground research and our analysis suggests. So enough on the human side. What I will do now is invite Aishwarya to take you through the various amount of financial crises that have happened in the world in the last 100 years, and Aishwarya can take us through that part.
Right. Aishwarya, before you begin, let me just, just a trivia thing. I just asked this on a poll question that I am worried more about A, my past returns, B, my future returns. Okay. So any guesses what the people are more worried about?
97%.
Yeah. So 97% say they're worried about their future returns. So that's the context, and that is why this discussion is so interesting. So over to you, and please continue.
Sure, thanks. So we always have to look forward. That's what Manish said. Market look forward, and similarly, we should also be worried about how our returns will pan out in future. Now, coming back, we will definitely discuss that in detail. But coming back and having the flow of the presentation, Manish talked about a lot of economic doldrum which we have witnessed for the last 100 years, and there were many other events, which were more like financial crisis which happened, right? We all know what happened in Asian currency crisis, and the fallout on the economy was huge, right? And we have seen most of these Asian countries have seen a big cut in their growth numbers, but once that thing settled down, we saw a very strong recovery which happened. Same thing happened in dot-com burst, right? Obviously, it took slightly longer time, at least 2 years, but then the recovery was pretty smooth, and I think the recent one we witnessed was GFC crisis, right? Where we saw almost, real GDP decline for almost 4-5% in US. And then there was the kind of growth we have seen over there. So the moot point remains here is what now from here onwards? Obviously, we saw COVID-1. We are struggling with COVID-2. Possibly there might be a COVID-3 or COVID-4 as have seen for most of the other countries. But I want to bring a very, very interesting data here. That if you really look at post August 2020, September 2020, till on March 21, those good 6, 7, 8 months, there has been a spurt in the activity in India, right? To take any sector. You look at industrial, you look at commodities, automobile, consumer discretionary, cement, especially real estate. Look at the activity which happened in the real estate over those 7, 8 months. You'll be surprised, even hotel, tourism, have seen volumes and occupancy, which they have not seen over last 1 decade or more. Right. So that spurt is an indication that once these things stabilize, once we are out of possibly COVID-2, this time around, we won't take much time to come back, and an economic activity will be onto a different acceleration, onto a different level. Like Manish talked to you about those numbers of GDP growth, we will not be surprised to see that number, right? Obviously, we don't know when and what about COVID-3, but we believe that will become more like a known thing, and possibly we will have a better way of fighting that, unlike COVID-2. So the impact on economy would possibly be very, very minimal. And we should not forget that interest rate, which has remained low for more than 1.5 years now, close to that, and possibly it will stay here for another year, has been more productive and conducive for the economy than anything else. So we believe that the growth in the economy will be pretty, strong once we get out of this, and that make a very compelling case to remain invested into equities. Now, if we move on to the next slide, if we have that kind of a view, what is more, it's like, who, what, and how to play this thesis, right? A lot of people talk to us that, market has moved a lot over the last year or so. Is it really safe, to remain invested or possibly invest? We are of a view that you should have take that view of putting your money and think about it, that whether your portfolio is pandemic proof and whether it has the required ingredients to see that wealth has been created years after year for a very long period of time. We believe that opportunities still exist. we believe that market has just not seen the kind of, the bull market we normally calls it. Whatever has happened in the last year or so is basically covered the losses of 2018-19 mostly. You will be surprised to know a lot of people tells us that, say, small cap has moved up 100%, more than 100% in the last year or so. Am I not worried? The point is, look at the BSE small cap indices return from 2017. You will be surprised to know that the CAGR return from 2017 is barely 6-7%. 6-7%, right? So if you really understand, look at your mid cap, look at your Nifty. Nifty has not been more than 44-45% return in the last 3 years, some 13-14% CAGR. Mid cap is much lower and small cap is like 7-8% or 6-7%. So what has happened so far is that they have recovered the losses of 2018, the losses of 2019, and the deep hole we witnessed in the month of February and March of 2020, and nothing more than that. Now, coming back to the slide, I believe this is a very interesting slide here. What is the requirement when you assess your portfolio? You should look out for these 4 red dotted, headlines. First of all, what has happened in this COVID crisis is that formalization has gained a lot of pace. What we mean by formalization here is the movement from unorganized market to organized space. In spite of our GDP, like possibly will degrow 7% to 8% for FY21, there are a lot of companies who had very, very strong leadership positions, what they have a very strong, moat around their business, strong pricing power. These kind of businesses have actually gained a lot from this unorganized player, So this formalization was supposed to gain pace post, GST implementation, post demonetization, but it didn't have the desired result. But after COVID-1 and COVID-2, it has been forced to see that moment. And we believe that you should always look at whether you have those kind of a business leader in your portfolio who have this kind of beneficial thing from the formalization, right? One who have increased in the market share, one who basically have strong brand equity and stock distribution, reach. So to make it exciting, let me give you some example here, right? Think about, say, tile industries. Right, we have seen that tile has a good amount of unorganized segment. Now we have seen like companies like Kajaria Ceramics, companies like Sierra, they have suddenly become seeing a lot of volume growth because a lot of this weaker unorganized player, has not been able to live up to that tough times. They have been very vulnerable. And all of it, the market share has moved to this organized player who not only have a high leadership, but have a strong balance sheet to take that growth. Right. Similarly, say if you look at say, areas like say, white goods, where we have not seen that kind of formalization happening because they already have too much of organized play in that space. Right. Another example could be footwear. In footwear, a player like Relaxo, which is part of our a Coffee Can, and even Kajaria was a part of our Good and Clean portfolio. Relaxo has been gaining a lot of market share from this marginal unorganized players. And then we have seen the kind of last 2-3 quarter result has been phenomenal. Similarly, if you see other sectors like cement, obviously they are the beneficiary of the cyclical side, but formalization is not playing out because there are anywhere between large 15-20 players in the country over there. So that is one area which we should definitely look at. Second is all about earning growth. Companies which has been able to show consistent and sustainable earning growth. And I can tell you, it sounds like passe, but this is what is investing all about, and simultaneously whether this earning has been converted into cash flows. We will cover it in more detail, but I want to give some example like a company called PI Industries, which is part of our Good and Clean portfolio, has been so consistent in the earnings over the last 3 years that they have created a lot of wealth for the investors. But on the other side, companies like some FMCG names, especially the weaker one like Jyoti Laboratory and all that, possibly have not been very consistent with earning growth, and we have seen that they have not been able to create return for the investors. Similarly, insurance sector has shown very high earning growth over the last 2-3 years. Guys like SDFC Life or even some general companies with ICICI Lombard. But on the other side, power sector is the one which has been lacking earning growth. Right, and we have seen that those businesses has not been able to create much dent over there. Coming to the third point is obviously the strong balance sheet. We always aspire to own businesses which are strong on the balance sheets, who have low leverage, who have efficient capital allocators, who generate high ROEs, high ROCs, and high earning growth. Right, so it basically separated men from the boys during tough time. what happened during crisis, a lot of these players who were highly leveraged were finding it difficult to stay afloat. And and that is what have been able to separate all this, what we say, wheat from the chaff on that over the last 1.5 or 2 years. So say things like, if you compare ourselves, if you compare on this parameter, a company called Avenue Supermart, very strong company with strong balance sheet compared to Future Retail. And we have seen how major wealth creation and destruction has happened into these two companies. Similarly, a company, if you look at from the banking space, those banks which has a very strong liability franchise, strong capital, have been able to garner a lot of market share over the last 1 year, 1.5 year or 2 years, whether it is ICICI Bank or SBI, whereas guys like IDFC First or RBL are struggling to remain, float that side. And last but not the least, we believe is the management pedigree which matters. It is always about management. Wealth is not created by finding the right businesses. Wealth is created by finding the right people who are running that businesses, right? Management who has not only have high competency, but have unparalleled level of integrity matters, right? And we have seen many such cases. Think about it. A company like, say, let me give an example here. A company like Raymond, right? Possibly the best brand in India today, deep rooted. Even if you go to tier 5, tier 6 cities, you can see that brand is in most an aspiration brand. Also, not only they have a brand equity, they have a very strong distribution around it. You can see a Raymond store possibly even in tier 4, tier 5 cities, even in most of those Zillas and all that places. So they have the right brand, they have the right distribution. Every product positioning is so strong, but possibly they have not been able to create that kind of wealth for the investors. Whereas on the other side, a company called, say, Page Industries, possibly, not that big a brand like Raymond. Uh, Distribution is also ramping up, but kind of wealth that they have created for the investors in mind blowing. So that is what it really matters. Similar examples could be Nestle's of the world compared to Imami in the case of FMCG. There are so many examples. So just to reiterate, I believe these are the most important criteria one should always look at, look out and reassess their portfolio, because after the moment that we have seen in the market recently, it's time to go back to your boardroom, take out the paper and understand and reassess your portfolio, whether this portfolio have minimum this 4 requirement of sustaining that pandemic proof requirement, is whether it is there or not. So I think I will stop here, and possibly Manish, if you can take it the interesting part from here onwards.
Thank you, Aishwarya. Now, what we are going to try and do in the next couple of slides is essentially to see and focus on the markets, the companies, the quality of the companies, and just defocus away from all the noise. Right now, we've seen in the last couple of slides that a catastrophe can be a catastrophe. It can be a financial catastrophe. It can be a human catastrophe, and our own country has actually, forget the global crises that have happened. There have been multiple instances in the last 20 odd years which have happened where it has looked like certain parts, certain sectors, and certain places are never ever going to recover ever again, and their life as we know it is never going to be the same again. And what I have observed, right, personally in the last 15-16 years, is that every time something like this happens, right, the first reaction that everybody has is to sell when the market is falling, right? And which is what happened last year as well. When the Sensex hit, went down from 12,500 to 8,000 levels, the first thing everybody called and said is, should we book profits? Should we sell? Should we liquidate the portfolio, right? Should we sit on cash? And what should be the reactions? And, in November, October, when the market started to rally and had gone about 11,500, everybody wanted to sell. Everybody was worried suddenly about valuations, right? The point is, there are two mistakes that we always tend to make. One is the fact that our time horizon is always short. We are never able to take the correct time horizon into perspective. And second is, we are always backward looking. We are never really forward looking, while the market is always forward looking, and hence a disconnect. So what you should, as an investor, always try to do is to swim against the tide. Every time there is panic in the market, everybody is fearful in the market, is the time when you should be greedy. And every time that all people around you are greedy and maximum amount of flows are happening and people are getting over optimistic on the equities and all money is getting pumped into equities, is a time when you should actually be fearful, right? So swim against the tide and realize that no matter how big a catastrophe that it may be, the market always tends to recover. All right. So we can see in the chart below the journey through 1990s and then 2001 to 2009 and then 2009 to 2021. And even if you look at it in the last 5 or 6 years, we've seen so many Six Sigma events which have happened right in front of our eyes. And what has that done? I mean, essentially, if you look at it, the economy still remains on a firm footing. They still continue to be amongst one of the fastest growing economies in the world. And if you would have chosen the right kind of stocks, right, and that is the biggest caveat over here, you would have still made a lot of money. Now, the point here, coming back, to the main question is that how do you choose the right kind of a stock? What essentially is, the identifying criteria for the right kind of a stock, right? So there is a twin prong approach that we usually take. You identify sectors from a top down perspective, but you identify the stocks from a bottom up perspective. But the basic mantra being, as Aishwarya referred to it, is consistency, right? And the more the consistent the company is, the more boring it will be perceived by the market, the better actually it is. Look at the journey, right? When you look at somebody like a Relaxo from 268 crores to almost close to 15,000 crores, right? We've seen a journey where we've had a 17-18% kind of a sales growth CAGR and 29-30% kind of a profit growth CAGR, right? And this has happened over a period of good 14-15 years. You look at something like a Pidilite, right, which has gone from basically being a adhesives company to a full-fledged consumer player. The journey has essentially been 100x. It has gone from 700 to 70,000 crores, right? And almost a 19% CAGR in terms of PAT. Now, this is where you need to differentiate the noise from the real material, right? The fact of the matter is, if you go down and go back in time, last year around April, May, Reliance Industries was in big time, right? There were deals happening on a daily basis, right? Not on a weekly or a monthly basis, not annual basis. They were raising money left, right, and center, and the stock suddenly zoomed through the roof from 800 to close to 2,000. And that's when a lot of people came back and started questioning us as to why is Reliance not there in your portfolio? You're missing out on so much of returns. Your stock has doubled, and X, Y, Z has made so much of money in this and this and that, right? And all those kind of arguments came back to us. But the fact of the matter is, if you looked at, if you're standing in August, right, end August, early September, and you looked at the last 10 years return, which Reliance gave you versus something like a Pidilite gave you. This is despite the stock doubling from 800 to 2,000 rupees. Reliance's 10-year CAGR returns were 16%. Not bad. Pidilite, probably one of the most boring companies that you'll ever come across in the entire listed universe space, had a CAGR return of close to 24%, an outperformance over Reliance of 8 percentage points. What are the advantages? You don't need to time Pidilite. Unlike a Reliance, you don't need to time your entries and exits. You will always consistently keep making that 15 to 20% return in Pidilite, and your money will keep compounding over a long period of time. Unlike in Reliance, where you could have sat on the stock for 5 years and not made a single penny. And then you made 3 months, and now from August till now, you look at it again, the stock continues to remain absolutely flat and you've not made any money in that again. So timing becomes important. In a long-term stock, you don't need to time. And the time frame becomes important. Equities is a platform which you need to use to create wealth and not to generate returns, right? And that becomes really, really important. So with that, I'll hand it back to Aishwarya to take us through the next couple of slides.
Yeah, so I believe this is a very, very interesting slide, and you guys must have been hearing that what matters in equity is all about earning. However passe it sounds, but that remains a fact. Someone has rightly said that stock prices are slave to earnings. So what we are presenting here, and I think this is a very important takeout from the whole presentation, that if you really look at, we have taken some 8-9 sectors here. Okay, and I will try to understand those companies who have reported higher and consistent earning growth over a period of time of say 10 years from FY11 to FY21. compare it to the another companies in the same segment and where we have reported lower growth, how their stock prices has fared. I so look at if you can I see those chart here, or I will help you to read it out. On the topmost left, you have auto sector, where iShares has given 22% earning growth, whereas Hero has given almost 3.6% earning growth in the last 10 years. This is CAGR earning growth trajectory of the 10 years. And that's why you can see the stock prices has a huge difference of 34% for iShares, same for 7% for Hero. Look at the banking space. In HDFC Bank, with almost 23% earning growth, reported same kind of an stock performance, whereas SBI has with a 10% earning growth has hardly performed in the last 10 years. Right? Same with Bajaj Finance when you compare it with Shriram Transport. Huge difference of 34% earning growth, able to generate 61% stock price performance, mostly added by re-rating also, whereas Shriram Transport has given 3% CAGR return in the last 10 years. Look at about even in the cyclical space. Look at on the cement side. Sri Cement with 28% earning growth over the last 10 years generated 28% stock price performance, whereas ACC with 2.3% earning growth over the last 10 years given 4% CAGR return in the last 10 years. Same even in the pharma. No, pharma is all about with a lot of participation from retail. Is the retail darling sector. A guy like Divi's, a smaller player, has been able to generate a 27% return on account of 17% earning growth. Whereas Sun Pharma with just 12% earning growth has been able to generate 12% return with all sort of volatility which we have seen. Right? Even in steel, even as I talked to you about cement, look at steel, the kind of return JSW Steel has generated because of the efficiency that they have, compared to Tata Steel. And FMCG is the one which we believe are the most consistent in earning. Compare the return of HUL versus ITC over the last 10 years. 14% CAGR earning growth of HUL has been able to generate 25% stock price performance, whereas ITC, I believe everybody knows about it, right? No price for guessing. And one of my favorite sector, look at IT, TCS, in spite of being a bigger size, in spite of being more difficult to manage, he's been able to generate 14% earning growth for the last 10 years, very healthy 17% stock price performance. But on the other side, Wipro, a very good, company with good corporate governance, but possibly all the volatility on the earnings has not been able to make a mark. So what the most important point I'm trying to make here is earnings matter, but at the same time, the other criteria which we discussed in the earlier slide also contributes a lot. So a case like Wipro, which fits with a strong balance sheet, which fits with a very strong management pedigree, who is a leader in the space, but missing on the earning possibly might not help you to create that kind of a return. And moving on to the next slide, what we have to really see that there is, a recency bias which always plays in the mind of investors. There's a kind of FOMO feeling which always plays, and that, somewhere misguide us to take the right decision. As I earlier said, a lot of people were talking to me that, market has moved up and all that. And I was talking to you through that number. Look at the return of December 17 to March 20 when Nifty went down 28% in that time frame. And from there, the Nifty went up almost 93%. But the return from the last 3.5 years is, in absolute return, is only 40%. And then look at for mid cap 100. And then look at for small cap. There is hardly any momentum in the market. It has basically covering the lost ground. Second most important thing is I believe possibly Manish will cover the framework that we have. But the need of the hour is to invest into quality businesses. Now, so there are very two interesting chart at the bottom. On the left hand side are the companies which ranks poorly on accounting and on the corporate governance, or basically are the one which will not have a very strong business moat around them. So even if you see, let us give some example. A company like Imami from December 17 to March 20 went down 27%, almost in line with Nifty, right? But went up almost 200% from March to 20 to March 21. But the return, the return is hardly still minus 27% because the 200% is coming on the recovery of the minus 25% losses that it has done. Similarly, look at Glenmark Pharma. Possibly might have gone up 150%, but the 3-year return is still negative -23. Same with Bharat Forge, same with KEC, same with n number of companies. When you look at the market has gone up in the recent time, it is these kind of companies where a lot of these retail investors who have become very active recently are finding their money, are finding the money or getting into pumped into all these things. But for long-term investors, this should never get swayed by that. On the other side, if you see good companies, possibly say a company like Page Industries, which have had some personal company-related issues of their growth and all, were given negative 35% return. But if you look at the performance over the last 3.5 years, they've still been able to stay in green with 12% return. Similarly, a company like Relaxo, or a company like Torrent Pharma or Nestle and n number of good companies will be able to better this volatility very, very effectively and generate very higher and better return. So coming out of this whole slide is that stay with the quality names. Don't get swayed by the momentum, by the excitement which is happening around. In long term, it's the earning which matters. In the long term, it's the quality of the business which matters, which can really get that operational performance and the consistency around. And that is what is required for creating the long-term wealth creation. Yeah, Manish.
Thank you, Aishwarya. So what I'll do is I saw certain bit of a comments, questions in the comment box which ask how to identify these companies, right? And essentially that is what I'm going to be focusing on in the next couple of slides, right? One is obviously that like I said, the sector identification has to be a little more top down rather than bottom up. You have to look at the economy. You have to look at the overall growth path and how things are going to play out. But the company research has to be very, very deep, identified bottom up research. So there's no substitute for hard work, essentially. But the fact of the matter is that if you are able to stay convinced and you are able to put all those things together, which is identify a management which is good, right? It's honest. Corporate governance practices are clean. Balance sheet is light and agile, right? You look at debt to equity ratio across all the three portfolios that we have, right? Nowhere does breach 0.5x on an average basis. It's below 0.5x on an aggregate basis across all the three: small cap, mid cap, large cap, everywhere, right? And that speaks a lot about the emphasis that we lay on balance sheet and consistency of growth. Are you able to convince yourself and answer this question that the company in question is going to be able to grow the profits at 15% CAGR? Then do not focus on returns. Returns will become a byproduct. Automatically, they will.
Manish, I think your frame froze. We lost you there. Manish, can you hear me?
Yeah, I think. Can you hear me?
I can hear you, Ashwin. I think we'll get Manish back. In the meanwhile, we have some questions from the audience. Okay,
Sure.
so we had asked a poll which stock they want to know more about, which listed 4 stocks. So PVR and Relaxo were a couple of them. So if you want to take any of them, discuss a bit in the time probably Manish joins, we can do that. Or you want to take it up at the end?
Sure. So
Manish is back. Good.
Yeah. Sorry, I got disconnected. Yeah. So if you're able to put all of that together and focus on the portfolio growth rather than on the returns, believe me, automatically the results will follow. This is just a sample average that we've taken, in terms of the CAGR returns across various companies from our different portfolios. But you look at the commonality in thread, the returns have all been phenomenal, right? 10-year CAGR returns are all phenomenal. But to tell you the truth, at the heart of it, none of us actually focus on returns. We focus on the quality of company, the quality of the management, and the consistency of growth. And the result automatically follows that the transition, in the last 10 years has been so dramatic across market caps. Small caps have become mid caps, and mid caps are now starting to become large caps across our portfolios, and large caps have become mega caps, right? And that is something which is so heartening to see. You look at the way the arrows are moving across the board: 49%, 37%, 36% compounded returns. So quality, in essence, always pays, and there is no substitute for quality. What is our approach? How do we do this? And you will see in the subsequent slide how consistently we do it. But the fact of the matter is, what is it? It's essentially good process. You have to have discipline, which is at the heart of everything else. There is no substitute for discipline. You have to have a philosophy, a guiding principle, something that shows you a light, and you have to live by it. We never deviate away from the coffee can philosophy or the good and clean philosophy, even if it at times means that you have to resist a temptation, you have to give up a money making idea. That is the most fundamental thing that you have to do. Second is deep research. There is no substitute to this. You have to do your hard work. Nothing ever comes in life easy, right? And the fact of the matter is, we, for a 1500 crore AMC, today have a dedicated 8-member research team. We do our own research, we write our own research, we build our own models, we do our own earnings projection, we do our own company meetings, right? I've not seen too many buy side people actually do it. They usually rely on sell side analysts to give them that. And third, like I said, have a business owner perspective, not an investor perspective, right? Believe that you own the company. Be focused on how good the management is. What are they doing? What are the promoters doing? Not just in this company, but other listed or unlisted ventures in terms of corporate governance. And be focused on earnings growth and the quality of that earnings growth. Return will automatically follow. It's a byproduct. And as a risk management strategy, simple. One word: discipline. Put all these 4 factors together and you will see the magic the way it happens. Your conviction will rise automatically from your heart. You won't have to need an external stimulus to make you convinced. You won't have to need an external, person to tell you, an outside person to tell you that stay convinced. But that's essentially what, simply put it is. And you look at it over here, this is something that we've really worked very hard on in the last 1.5 years, and this has been received very well in the market. We call it the disruption series. We take a 10-year view on each and every single industry and each and every single stock in our portfolio. And we try to ask ourselves this question as to what can possibly go wrong 3 years, 5 years, 7 years, 10 years out into these companies, right? And how are these guys going to mitigate that? And essentially, it takes about a month and a half of the whole research team's effort goes into it to come up with these notes. But when you read it and do mail back to us, and we'll be more than happy to engage, but you'll see the depth that we get into, the amount of homework and the hard work that we put into to come up with the consistency that we do. And when I talk about consistency, this is what I mean, right? Across the 3 portfolios, if you see the returns, Coffee Can, 20% compounded returns, outperforming the markets by a whopping 7 percentage points across a 3+ year time frame. You look at Good and Clean, hits the ball out of the park, 4 percentage points outperformance as compared to the benchmark index over a 6-year time frame, right? 6 years, 4% outperformance. And then you look at the superstar product that we have, which is Emerging Giants, 17% returns in the last 3 years, outperforming the broader markets by 11 percentage points. And not only have we grown consistently and outperformed the markets consistently, but in tough times, we have protected your money very, very consistently. Look at the highlighted part, CY18 and CY19, and you look at the way the mid cap index and the small cap index fell, and the way we were able to protect the money, right, in tough times. It is in these tough times when, the men from the boys get separated. Making money in a bull market is very easy, but protecting your money in a bear market or in tough times is actually probably the most difficult thing that a fund manager can do. And it is this discipline, I think, in one single word, which sets us apart from everybody else. So with that, what I'll do is we'll stop the presentation here and we can open the floor, Sankalp, for question and answers.
I put a lot of them, and I hope I can take most of it. So we will start with the question that Chauhanji had asked, and you kind of touched upon. So A, how to identify these stocks without the advantage of hindsight, and B, how do you probably have the conviction, because a great significant portion of your presentation and discussion today talked about having the conviction and having to test waters and stay patient. So how do you do that? And how just a little bit more on what are the characteristics according to your Good and Clean and Coffee Can philosophy of some of the potential winners? So any one of you can take that, Aishwarya or Manish.
So I've already spoken a lot about it, right, in my presentation. I would want Aishwarya's perspective on that. Aishwarya, if you can just give what you think.
Aishwarya, you there?
Yeah, so I think this presentation we covered mostly the whole this question only. So yeah, can you hear me?
Yeah. So can you just then focus on the part?
Yeah,
we can hear you. Can we just then focus on the part where you talk about how to keep the conviction high at all times? Let's just focus on that for then now.
See, conviction can't be borrowed, right?
Right.
Conviction has to be developed, right? And when we invest, we don't invest like we are buying stocks, right? Our idea is very simple that we are buying businesses. Whether
Hmm.
this is the business, I want to put my money onto it. And what we do is, once we are convinced about that business as well as the management, we stay the course, over a long period of time. So when you give some example, right, whether it's say a company called Alkyl Amine, which where we invested long back, three and a half years back, we were not only convinced about the sector, the whole amine industry is his stronghold in that space, but we were equally, confident about the business as well as the management over there. And you won't believe we made the biggest money over there by staying the course. The stock has gone from almost 1,000 rupees to almost 10,000 as we speak. You can't, until unless you have the conviction of knowing that business well, knowing the promoter very well, you won't be able to stay the course for a long period of time. Same thing like when you invested into PI Industries, it was one of the very difficult sector to understand. Chemical is a very difficult sector to understand. We had to spend too much time with Mayank and his team to really understand what it's all about, right? And then you build that a conviction and then stay the course. Second thing, that's what Manish said, no, we always stay away from momentum. It's very, very important. You have to, when you buy a business, you are buying it for infinite time, thinking like that. Rather than trying to play the cyclicity of the business, and if you someone think that they're very smart, that they can have the right entry and the right exit, it's easier said than done. So we don't get into that thing at all, right? So that two things we look out for. Obviously, like one is consistency, which we really like in any business, and how scalable it is. The Manish, when he showed that present slide where companies has moved from small cap to mid cap to large cap to mega cap, only two things is required for that movement. One is consistency of that business. Second is scalability. And we
Right.
get convinced on these two parameters before we invest.
Okay, okay. I hope Chauhanji and Rahulji that answers your question. So another question, which was a poll question, we took up which companies to discuss. So the two companies with the maximum number of preferences are Relaxo and PVR. So can we just have a brief at them? What is your view and how do you think they are pandemic? Over to you.
Yeah. So I'll take up Relaxo and I'll leave PVR, which is slightly more difficult one for Aishwarya. I'll back the easier wicket out. Relaxo is something that I'm very, very convinced about. Why? Not just, again, like I said, not just for the company in itself, which is great, right? It is fantastic. But from the category perspective, right, you have to really take a look at the big picture. And that's probably one of the most difficult things to do, to be able to think long term, to be able to take a top down view. Now, think about it. Footwear is an industry which is always going to be in. It is a classic India growth play story, which kind of plays out, right? And it plays out not just from people moving from unorganized to organized, but even from people moving up the value chain from lesser expensive shoes to more expensive shoes. And we've seen that play out not just in Relaxo, but in Bata. You look at it in the last 10-15 years, Bata's average realization per shoe has actually moved up almost close to 4.5x now, right? What used to be 100 rupees is now today 400, 500 rupees plus. And it is not inconceivable today to be able to sell a 2,000, 3,000 average price shoe in a city like Bombay, Delhi, the top 6 metros. So the advantage over here that it becomes is that one is that the category is underpenetrated. So it is going to grow consistently. It becomes a classic India play in that sense. And more importantly, there is a very significant presence of unorganized players in the business, in the category. And that makes it even more attractive. When you take men's shoes, it's almost close to, 30 to 35% unorganized. When you look at somebody like a women's shoe as a category, it is close to 90% unorganized, right? So that transition will continue to happen because the only thing that has remained consistent perennially, right? Perennially across time eternally is aspiration to lead a better life. Right, and that is essentially what the play over here is. And when you look at children's shoes, school shoes in particular, the realizations again there have been moving up. So a company with an amazing amount of brand equity, spending anywhere between 8 to 9% consistently as a percentage of their revenues, sales behind advertising, consistently growing as far as volumes are concerned. Now they've started taking the prices up as well, so your realizations will also kind of start moving up. 7-8% price hike that they have taken. Balance sheet continues to remain absolutely strong. So if there is one pandemic proof company that is there out there, and for which I kind of remain absolutely convinced about, it has to be Relaxo.
Right. Before we move on to PVR Aishwarya, let me just have a follow-up question there. What happens a lot of times is, like in cricket, there's the nervous 90s, when a player gets released at three, completing his century. So, what I call nervous 90s for high PE, high valuation stocks, I know that's a bad word these days, is something called a time correction, or, where these stocks don't do anything for a long period of time, having just performed stellarly on business and stock price appreciation. Examples are abundant. Probably Page was one of those. Eicher is probably another of those. Mahindra and Mahindra is probably one of those. So are there these concerns that you feel could be there around brands like Relaxo or Bata, where they where the valuations of run ahead have probably for a time period run ahead of their time, and there is some sort of stagnation around there?
So that's a fair question, right? Homework is not something that you do before the exam or before a class starts, right? But it's something that you have to do through the years, right? So it's the same principle that applies in investment as well, is that your homework has to be consistent and it has to be continuous on an ongoing basis through the period that you are invested in, right? And that is why your risk reward assessment strategy has to be continuous. And risk reward can be different for two companies in the same sector also at different points of time. You might actually feel favorably inclined towards one, you might not feel so favorably inclined towards the other. But what we try to do is to avoid looking at P multiple in absolute terms and take a judgment call that this is an expensive stock or this is a cheap stock. I don't believe in that. We in Ambit don't believe in that. Just because something is 25x, it doesn't mean it's cheap, and just because something is 50x, it doesn't mean it's expensive. So we have to shed that mindset. It's about growth versus multiple. Quality will always come at a certain price, and you have to be prepared for it. A Prada bag or a Gucci bag is always going to be a little more expensive than bag it, right? So you have to kind of take that factor into account. So what we do is in our asset management company, we rely a lot on reverse DC. And we do this exercise at the beginning of every month. The first week of every month is what we do. The whole portfolio of 47, 48 companies that we have, we run this, reverse DCF on each one of them. And you see what is the next 10 years kind of a growth that this stock price is now building in. And are you comfortable with that? Right? Because the India of today is much different than the India of 20 years back. So in that sense, if you look at the long-term PE chart in absolute, everybody's going to be running from here to here, right? It's always going to be a straight line that. So you can't take that as expensive. So it always has to be risk versus reward strategy.
Right. So we will take that quick, on PVR from you, Aishwarya, and then we'll move on to a couple of another interesting questions. Aishwarya, can you hear us?
Yes.
Yeah, please. Okay, in the while Aishwarya comes back with PVR, so I've got another question which I had asked in the poll about the sectors that people want to know, and Mr. Amit Khanna also asked this question. What do you think about the real economy sectors, like the metals, the steel industries of the world, probably auto, capital goods? What's your view on that? Aishwarya, we'll come to you. We'll just take this quickly from you, Manish.
Sure.
Yeah. So I'll take the first part of this question, and maybe Aishwarya can add, to this question after me, and then he can continue on to PVR also. But the fact of the matter is, when you look at these high beta stocks, if I may call it, right, and low P multiple stocks, if I may call it, they had been languishing around for a very long time. Right, when you look at it, the whole rally in India, or the money making process in the equity markets in India, right from 2014-15 right up till April of last year, was essentially being led by more expensive names. So, some people termed it as polarization, but essentially it was expensive stocks which continued to get more and more expensive. It was the FII money which was flowing into our country, and they were basically chasing consistency and quality in tough times. So you did not have that much of a confidence in these cyclical industries or stocks, if you might want to call it. But now, when you look at it, post-pandemic world that we are living in today, and it's not just India but globally, the economic revival is massive, right? When you're looking at a country like US registering a 7% GDP growth rate this year, and then we are talking about a 6 to 7% kind of a GDP growth rate in Eurozone, we are talking about a 9% plus GDP growth rate in China. And at least according to us in Ambit Asset Management, we believe that India's GDP is still slated to grow at 11% plus pace this year as well. Obviously, there is going to be a lot of demand pull that comes through as far as these commodities, cyclical commodities are concerned, especially metals, right? And also agro commodities now, which have started to perform really well. But also some part of it is because of supply side constraints. For example,
Right.
Brazil, right? The crop failure that has happened in coffee and sugar, for example, right? So that kind of lends a little bit of inflationary pressure as well. But are we looking at a continued, rally as far as these metals are concerned? I would think so. In fact, inflation is going to, at some point of time during the year, become a major headache from a global economic perspective. And, most of these central banks will have to take bite the bullet in terms of what rate hike action will they probably take, or at least a body language change from dovish to hawkish. But I would feel that the economic growth in India from the next 2 years perspective is going to be slightly different than what it has been in the last 4 5 years. So there is going to be a lot of play from banks, right? Especially quality banks. There is going to be a lot of play in consumer discretionary. There is going to be a lot of play in auto. There is going to be a lot of play in some of these cyclical industries. So that's what I feel. Aishwarya, if you want to add to this.
Right. Okay,
No,
we'll take
I
it from Aishwarya now.
completely, yeah, so completely concurrent to your views. As the economic expansion happens, cyclical will be in favor, and they have been beaten down for a long period of time. But our only suggestion would be that if you stays in cyclical, stays into the best names there, one who are the largest, or possibly where we believe that the balance sheets are the strongest, or the one where the leadership position is the highest in that space. So it's because the easy money has been made already. And that's very important to understand. The remaining money will be only made by the leaders, and one if your capital allows you, if you can take that kind of a moderate risk, investing some part of your allocations towards cyclical might not be a bad idea. So that's the point I want to highlight. Coming on to the interesting part, PVR. No, it's a very. I think there should be a case study on PVR sometime, in future. PVR is one investment that we have in GNC, and tough time because we all know movie exhibition is closed. We don't know when it will open up again. But more we think about it, what we realized it that a crisis like this has become blessing in disguise for player like PVR. You won't believe, the whole paradigm gonna change post COVID compared to what it was pre-COVID. We have been hearing about that there is a risk, people possibly might not go to theater. There is a risk because of those in-house entertainment, your Netflix and Amazon and whatnot. Now the dust has settled big time. Right. First of all, people have enough of watching Netflixes and in Amazon. We have seen one of the biggest release very recently, and what was the outcome of that? Second part is the most important part we should know is, India is basically a single screen market. I think it's more than 64% of our exhibitions happens through single screen. Nowhere, if you compare ourselves to Asian countries, forget about the US and the Europe of the world. We are not comparing them to them. Most of the Asian countries, 100% is all about multiplexes because everybody wants to have their own experiences. This COVID is letting all this single screen basically go bust. I will not be surprised to see that percentage going below 50% here. Even on the 35% of the business which is organized, there is 5 6 players, and we will not be surprised to see only 2 players exist there. Think about it, when we come out of it, instead of six players around that, you only have 2 options and 2 players who possibly have the strongest balance sheet to survive. And the third question is, people really think about whether in PVR can survive or not. PVR possibly have survived so far, and they have raised money very recently at a very good price. So they have all the likelihood of surviving through this crisis also. And we are now closer toward unlocking of things. Possibly, if things are sanguine, we will open up in a month time or a 2 month time period at worst, and then possibly we will see that thing playing out. If I may say, we believe a lot of money will be made in PVR once the reality will start that the formalization has actually happened on a big scale. And I can tell you, all inclusive people around here, people will love to go out and venture once that normalcy comes. People will go out and spend some time with their families. We have enough of sitting on and doing binge watching. So we believe no, it's not only about PVR. It's about various other businesses, possibly hotels, possibly tourism related. Those businesses which are more related to opening of economy, they will do really well from here onwards. But we want to stay with those where we where the chips are in our favor, and PVR is definitely one of them.
So, Sankalp, I can't hear you.
Yeah, Sankar.
So sorry, my audio was mute. So I'll have to take a question on exit with you guys, because that's something a lot of investors either A, get horribly wrong, or either, they probably don't exit for a very long time. And then in cyclicals, what happens. So exit has always been a contention, and you proclaim and say that we are in for the long term, maybe 10 years or so. So when do you know it's time for you to exit? And have you exited any stock? You can just give us an example, and why you exited probably will be a good case in point for the audience today.
So let
So,
me give my initial thought,
Aishwarya,
and
you want to
possibly
take this?
Manish can. Yeah, so I will initially give my initial thought, and Manish can just add if you wish. So first of all, we are not too much into cyclical, and your exit and entry is very, very pertinent, more in cyclical than those compounding stories. But yes, we obviously invest with a long-term mindset, but we are always equally aware or cognizant of the fact that how that valuations and growth are playing out, right? Especially in mid caps and small caps. So let us give you some example. We had some investment we did in Alkyl Amine, as I said to you earlier, right? But when the valuation started from 10, 11 time price to earning, when it went to almost 45, 50 times, and when we see that money has already become 5 times, to be honest, around 4.5 times, we started thinking that the growth and valuations is slightly getting stretched, and we started taking money off 10%, 15%, and we possibly more or less have exited it now because the stock has gone almost like 7, 8, 9 times, depending on the different level of things that has happened. Similarly, like there was another stock where we invested, which was GMM Pfaudler, the leaders in the glass lining thing, and the valuations from almost 15 times price to earning went to as high as 120 times price to earning. Even for a 35, 40 time group or percentage growth, it was trading at almost 4 time PEG. So we understood that there is some sort of uh, artificial float which is very limited, and the retail participation has become very heavy. We decided to take that money off at around at 55,500 rupees, almost when the money was almost 5 times. Let me rephrase that. We only exit if we believe that valuations is just not defying fundamentals. It has completely gone out of whack. No, so if you ask us whether we sell Relaxos or the Asian Paints of the world, or even or we have another investments like Garware Technical Fiber in our portfolio, right? We haven't taken any money off the table because their growth and valuations are pretty you know. Are pretty much in line, pretty much in a concurrent way. We always take money off when we believe that there is some sort of, too much of optimism, or for a short period of time, things have completely gone out of whack. That pushes us to when we find it difficult to justify those valuations to ourselves. Having said that, another reason I want to highlight here for all of investors, that valuation is just not the only criteria. When we were selling Pfaudler, there were other reasons for it well. So because the float was technically so low, and the way the retail participation was happening, that was giving us sleepless night. And so the liquidity comes into play, float comes into play, possibly the growth prospect for the next 3 to 4 years comes into play. So a lot goes into assessing whether we need to stay with the business or exit that. I will always recommend that equity is there for forever. One should always only sell when if you are really finding difficult to justify. Try to remove your scissors from the portfolio. It will do really well. The more you try to trim, the more you try to do something, it will eat up your return. Or, more or less. So my only thing is that you should not be very active. If you like some business, stay there for the long haul. Cut only if you have very solid, strong reasons to do that. Manish, if you want to add something on this.
No, I think you've summed it up very, very perfectly, Ashwin.
Right. So then, somebody's asked about Amritanjan, and I find it a very curious talk and a very curious company. So if you want to spend some time on that, that'll be nice. And after that, we will just take a question. We just take some time on discussing or just couple of snippets on the 3 portfolios that you have. And with that, we will probably wrap.
So, Amritanjan.
On Amritanjan.
Yeah, sorry, go ahead.
Yeah, Manish, go ahead, please.
No, please go ahead.
So I will just give my initial thought, and I think you are an FMCG expert, so I think it's good if you can add more to that. What excited us about Amritanjan, obviously we have seen this as a consistent player for a very long period of time, right? But more than consistency, we're excited more about scalability in that business. So the coffee that is that women, the sanitary napkin business which was there, we were able to see that these people are touching the right strings in that business, and possibly the focus of the management and that particular space was so exciting to us. We believe that the penetration level growth, there are very few quality brand which gives affordable product in that segment. There's like a blue sky scenario in that particular space, and that really got us excited about this business. That business, even though the kind of growth it is witnessing, is still very small, but we believe that momentum which is building up into that space can really take it to places, and that is one of the reasons which we are holding on to this name. Stock has done somewhat well over the last year or so, but we believe that a lot is left. And we believe once that business starts snowballing over the next year or two, there would be a massive re-rating which will happen in companies like this. And that is the reason, we are really excited about it. Manish, if you want to add anything on top of this.
Right, excitement to the tune of it being the largest holding in your portfolio.
Yeah. No, I think it really sums up, what you said, Aishwarya, is very true. It really sums up the whole thesis, right? When you look at feminine hygiene as a category, especially more so, from a rural perspective and semi-urban perspective, because the likes of P&G essentially do not find it lucrative enough to expand their distribution or direct reach into these parts of the countries, and that's really, really a deeply unexplored area as far as this category, that entire category is concerned. Not to say that we find pain relief unattractive. But this is a category that has not just grown by leaps and bounds in the last 4, 5 years, 10 years, right, and become a substantial portion of their overall revenues. But I think what you've just seen so far is just the tip of the iceberg, and this kind of double-digit consistent growth in this category is going to probably continue for the next decade or so. It's an ideal candidate to graduate from emerging giants into good and clean, and then from good and clean into coffee can.
Manish, your camera is off for some reason.
Yeah, I don't know. I was getting disconnected again and again a couple of times. So I thought maybe bandwidth issues. That is why.
So, anything on Amritanjan, or should we just discuss for the next couple of minutes the 3 portfolios that you have, and with that we'll probably wind up.
Yeah, we can go with the portfolios. I spoke about Amritanjan. You guys were able to hear, right?
Yeah.
Or should I just? Yeah.
Yeah, we heard you.
Yeah.
No, we are able to hear it.
Yeah.
So Manish, can we have you talk about the coffee can portfolio in a very crisp way?
Sure. So I'll sum up coffee can for everybody in just 3 or 4 bullet points. Not too much of paraphernalia. We'll remove everything around it. It's very easy and simple to understand. There's no complication around it. Essentially, what we look for is consistency. Right? That's essentially the cornerstone of the whole philosophy. Companies which can deliver consistent profit growth, and we believe that over long periods of time, this profit growth automatically converts into stock performance. You don't need to worry about that separately. It's a byproduct that it becomes. But at the same time, it is meant ideally for an investor who's low risk, long-term oriented, and is looking at consistent returns across long periods of time. Anywhere between 15 to 20% return year after year, every single year. in a consistent manner, not worrying too much about the bull runs and the bear cycles of the market, peacefully sleeps through it. We are not looking to outperform the market every month or every week or on a daily basis. It's more of an absolute return product. So ideally meant for people who are looking to create wealth over long periods of time. So that essentially sums up everything about Coffee Can, and that also shows in the consistency of the return that we've delivered over the last 4 years, 3.5 years, right? About 20% compounded returns. We can move to Good and Clean and
Aishwarya,
Emerging Giants.
Yeah. So on the other product we have, which is Good and Clean, is more biased toward mid cap, and Emerging Giant is more biased towards small cap. The idea is very, very simple. We are finding the best mid cap companies in India today for Good and Clean mid cap fund. We're finding those companies which are mid cap today, which can become large cap of tomorrow, creating very high returns for investors in that journey. Right. The basis of finding those companies is our philosophy is of Good and Clean, good companies which are consistent track record on capital allocations, high earning growth, and most importantly, clean is all about accounting fairness and corporate governance. I can tell you there are very few good quality mid-cap companies, and through Good and Clean mid-cap fund, we are giving you on a silver platter the best mid-cap companies that are there in country today. Similarly, finding a small cap, quality small cap, finding the next Alkyl, finding GMM Pfaudler on all these kind of companies is a daunting task. There are 2,000 small cap companies. Finding those right 15 companies is very, very difficult. What you're trying to do here is to just go and find these companies, and that too early, in the cycle. So we are trying to find out the small cap company which can become or become a giant over a period of time. Companies which have shown consistency as well as that who have scalability. Most important point here is that in spite of being small cap and mid cap, capital protection is of paramount importance. So when you see the performance of the schemes, even during the worst of the time, when the markets were in deep cut, these schemes have outperformed. At times they were in green compared to when the markets were in red. It only happened because these are possibly no leverage or very little leverage, high ROE, high earning growth, very strong businesses, where we believe that they can really make big in the course of time. These are pretty concentrated portfolio of around 15 to 20 businesses where we believe that they have the right, ingredients to become big.
Right. Thank you so much, everybody. Thank you to the listeners for joining us on a weekday evening on this call. Thank you, Aishwarya. Thank you, Manish. Thank you to the team at PMSCIF World for organizing this. We hope to see you guys soon and wish you all a very safe time. We're going through very difficult times. I hope everybody can stay indoors and stay safe. With that thought, thank you very much to the team at Ambit again. We will see you guys soon again, and I hope to see you guys also next quarter coming up with how your pandemic proof portfolio has done. So excited to see you guys again, and thank you as always.
Thank you so much.
Thank you so much, guys.